we all know that last year the tech sector made lots of money, I would say. And how was it for you as a tech fund manager yourself? I'm sure you're very proud, very happy for last year's returns. But take us through what happened last year. What are the highs and what are the lows?
Sure. So, I think coming into last year, we were feeling pretty positive on technology, which, I know not many people were at the time. And we felt that for a few reasons. One, we felt that, positioning in technology really got to extreme lows, from extreme highs. Everyone had finally kind of moved out of technology. We felt that expectations in technology had come down a lot. And then we had, a major new, technology wave with AI and the launch of ChatGPT. And we felt also that, rates were, peaking at some point during 23, and we had a bit more of an idea as to where that peak rate would be, which for us as growth investors was the key. And as we rolled through 23, I think a lot of that played out. We didn't get the big downward revisions to earnings. People started coming back into technology, and I think people realized quite how important that launch of ChatGPT was and generative AI was going to be. And then ultimately by the end of the year we had the full Fed pivot, and people felt more comfortable with growth stocks. But you put that all together and you had obviously a very strong year for technology after what had been difficult in 22. And I think what's exciting for us is we still feel very early innings in the innovation that Gen AI is going to bring. So this is far from the end. There's a nice recovery, but much more to come from the technology sector.
And just want to expand a little bit on that. During 2023 itself, you can see even though tech did so well by the end of the year, there was a lot of volatility in between, right? Especially during August to October. Maybe you can expand a little bit on that.
Sure, and generally our view is, don't try and time the market, it's about your time in the market. But also, I think the world has been very obsessed with interest rates on the way up and then on the way down. And that's not a normal state for equity investors in the stock market. We don't tend to over-obsess on rates. That's what fixed income and bond people talk about. But obviously, we went through some quite extreme. We've had zero rates, and then we had concerns that because of inflation, we'd have rates up at 7 or 8%. And I think what you saw in sort of late summer into sort of that latter part of the year before we had that Santa rally was the market getting a bit ahead of itself, thinking that, oh my God, actually economic data is stronger, we're not getting that recession, so rates might have to go higher because inflation's not cooling down. And then by the time we got to October, actually, no, we're actually having a full Fed pivot and rates are going to get cut as early as March this year. So we had that kind of complete U-turn in the space of a few months. I'd like to think that that's a lot more in the rear view mirror, and as we look forward, now we know that rates have peaked. They're not going to go back to zero. They're probably going to be in a 3 to 5% range over the next few years, and that's absolutely fine. And then we can get back to, forget about rates for a bit and just get back to stock picking, fundamentals, dispersion, good stocks, delivering profits, doing well, bad stocks where expectations are too high, valuations are too high, doing badly. And we can hopefully expose, clients to the former camp and not the latter camp.